Hello, everybody. We're going to spend some time today talking about credit and debt. Now, one of the first things that comes to mind when people hear the word debt is that it's a bad thing, and that really can be the truth. Debt, if not managed properly, if you borrow too much and can't cover those costs, if borrowing for things that you shouldn't be borrowing for, it's a bad thing. Absolutely. But debt and credit are not always bad things. Have you ever heard the term leveraging credit? If you haven't, it's real. It's a thing. But in order to do it right, you need to really understand what credit is. You need to understand debt. You need to understand how to borrow properly and all of that. And so that's what we're going to spend our time talking about today. Why would you need to leverage credit? What does that even mean? Basically, credit is your ability to borrow money. So you do need to borrow money at times. Most of us will need to borrow money for things like, going to school, college, university, trade school. Most of us will need to borrow money from time to time to buy a car or some other large purchases like a house. Leveraging credit, if known how to do well, is a positive thing and can be part of your overall financial wellness. And what we're going to do today is talk about how to do this properly. So first off, what's credit? Just like I said, this is your ability to borrow money. Your credit is your worthiness of borrowing money. If you have good credit, it means in the past you've borrowed money well and you've repaid it well. If you have bad credit, it means in the past you had some situation. Doesn't mean you're a bad person if you have bad credit. It does mean, though, in the past you've struggled to pay back some of the things that you've borrowed. So we need to understand really what that means. And who are we borrowing from? Usually those that are lending money are banks, credit unions, other lending institutions. What they do is they lend out money and they don't lend it out for free. What they wrap in there is something called interest that we're going to learn about today. Interest is the fee to borrow money. They're earning money by lending you money. So let's take a look here for a moment. Why would you need credit? Well, we covered some of these big things. You might need credit for school. You might need credit for a car. You might need credit to buy a house or another big purchase. But did you know there's other things that credit comes into play for? Did you know that they also check your credit when you go and get a cell phone package, like through AT&T or T-Mobile? They're checking your credit. They check your credit to rent an apartment or to get a job in many times, or insurance. Sounds a little strange, but it's true. I understand a little bit with the phone service and even renting an apartment. What they're doing is just making sure that you are somebody that in the past has been able to pay for the things that you owe. But what about getting a job and getting insurance? You're not borrowing money to get a job or borrowing money for insurance per se. What they're doing, though, is they're just trying to gauge how credible you are, how responsible you are. Now, it's not always perfect. Someone could be very responsible and have bad credit, but many times jobs, insurance, and many others are going to check your credit. So it's really important not only for you to be able to borrow money and borrow money at a low interest, which we're going to look at, but just your ability to be able to get through life. You should have good credit. So in order to have good credit, you have to be a responsible borrower. What does that mean? Well, we have a few things that we're going to cover here. First off, should not even need to be said, but it does need to be said, borrow only what you can repay. Do not borrow money if you cannot repay it. If you're working at McDonald's, that's great. All of us have done that at a time. But if you're working at McDonald's, you probably shouldn't borrow money to buy a Lamborghini. You're not going to be able to cover those costs. Need to understand where you are and what you can cover. And later on in life, you probably maybe will be in a situation where you can buy that Lamborghini, not when you're working at McDonald's. Read and understand the credit contracts. They're complicated. In those credit contracts, really what you need to focus in on is how much is your interest? When you're borrowing money, you want it to be as low as possible. What are your payment due dates? What are the loan terms? How many years do I have to pay this thing off? And are there ramifications or impacts if I pay too early, if I pay too late? What's the grace period? Understand that. Do not sign that loan. Do not get that credit card if you don't understand that. Pay your debts on time. Do not miss your payments. We're going to see later on that this is one of the most important things you can do when you borrow money is pay your debts on time. Notify your creditors. If you can't pay on time, there are times when you're not going to be able to pay your debts on time. Maybe some emergency happens and you're going to miss a payment. Don't hide from it. Call that credit card company, call that loan company. The more they know, the better. Make sure that they have that information. Oftentimes they'll help you by creating some sort of a payment plan. They can also help you by making sure that doesn't negatively affect your credit. And then of course, report any lost or stolen credit cards. That's really important. So many times we talk about this thing called a credit report. You've probably heard people talk about it before. Basically, it's a whole report of your credit history, what you've borrowed, how well you've paid it back, and much more. There are 3 agencies, Experian, Equifax, and TransUnion, that gather information and produce reports for you. Each of them have their own reports. They should be similar, but they're not always the case. You probably should check your credit reports at least once a year, and the best place to do that is annualcreditreport.com. That is really the only place you should be checking your credit reports. It's a federally regulated website that you can pull one free credit report from each of these agencies each year. It's a good idea to do it. Now, if you go onto that website, you got to understand you're going to have to give some personal information for them to prove that it's actually you. So be ready to give your full name, your social security number, address, date of birth, all that stuff for them to be able to prove it's you. But then having a credit report, it's really powerful. You can see where you're at. You can also see if there's any mistakes. And if there are, make sure you try to fix them. In fact, on this annualcreditreport.com, right online, the credit reports allow you to dispute any of these claims that you think are not yours. It's really important to do. So there's also something called a credit score, which actually came after the credit reports. This really smart company called FICO, Fair Isaac's company, came up with a way to take all of these reports, build some crazy algorithm around it that spits out a score for you, which helps out those that are lending you money. It's an easier way to kind of gauge. It's also easier for you to understand how well your credit is if you have a score rather than just a report. Both are really important, but this credit score is a little easier to comprehend. This ranges from 300 to 850. 300 is terrible. I don't think I've ever met somebody that's had a 300 credit score. 850 is excellent. I've also never met anyone that had 850. You're going to be somewhere in the middle, hopefully on the higher end. Anything over 700 is good. I try to shoot to have 750 or higher. If you want to check your credit score, the only place you should really go is myfico.com. Some of you might have a bank, credit union, or even a credit card that'll give you your credit score for free, and that's fine as long as it's a reputable company that you're getting that from. So what makes up this credit score? A few things, a number of things. Really, there's 2 I want you to focus on. The first one is the payment history. Pay your bills on time. Sounds so easy to do, but it's not always. Don't forget, don't get over your head. Just pay your bills on time, and if you do that, that's 35% of your good credit score. Another 30% is your balance to limit ratio. Basically, that means if they're allowing you to borrow $1,000, don't borrow $600 or $700 of it. What it shows is, whoa, this person is getting really close to the amount that they're allowed to borrow, and that's a risk. Try to stay under 50% of amount of money that you're allowed to borrow to make sure this balance to limit ratio is set. If you do those 2 things, that's 65% of what makes up a good score. The other things are important too, but these are the most important. Length of history, how long you've been borrowing and such, that's also important, but you can't control that as much as you can the first 2. So what happens if you have good credit, let's say a 780, and you make some mistakes? Because guess what? Making mistakes is going to happen, but know it is going to affect your score. If you max out that credit card, expect your credit score to drop 25 to 50 points. If you're 30 days late on a payment, expect it to drop about 100 points. Debt settlement, about 100 to 125. Foreclosure, if you foreclose on your home, 150 basically. Bankruptcy, although it lists 220 to 240, it can even be more. Now, these things happen, but when your score goes down, that makes life difficult for you. It makes it very difficult or impossible to borrow money in the future. It also might make it difficult for you to rent, like we saw, or get cell phone service, or even get a new job. So let's look at why it's important, besides having the accessibility to all those things, to have a good credit score. Let's take this example. You got a $20,000 auto loan. So a $20,000 car, you have 3 years to pay this puppy off. So Let's look at this. Look at this first line up here. That's good credit. 720 to 850 is great credit. Your interest rate for that car loan is probably going to be around 6%, which would make your monthly payment $608. That's a lot of money. But look what you're doing here. You're only paying less than $2,000 in total interest for that car. That's not that bad. Look at the bottom row. This is the same car, same $20,000, same 3-year term, but if you only have, let's say, a 575 credit score, instead of 6%, you're paying almost 19% interest. The more interest you pay, the more expensive it is. Your monthly payment went up to $730 per month, and the total interest you pay, over $6,000. It pays to have good credit. So we just talked about interest rates there. Let's look at how that works. Basically, interest is the cost to borrow money. You don't borrow money for free unless you're borrowing from a friend or a family member. And sometimes they don't even give it to you for free. Usually interest is referred to as annual percentage rate, or APR. So that's how much the percentage is per year. But it doesn't mean that it's compounded or assessed every year. It's actually usually assessed either monthly or even more commonly daily. So for instance, if you have a credit card that's 12% interest and it's assessed every month, that means that it's 12% divided by the 12 months in a year. So it's basically 1% interest you're paying on how much you owe every month. But reality is most interest is assessed daily. So that's that 12% divided by 365 days per year. It equals about 0.03% per day. Sounds like a small amount, but it sure adds up. So to wrap this whole thing up, what can you do? Well, you can, if you're responsible and you can do it properly, you can start building credit while you're in college. You could get your first credit card like I did in college. Now, I was not responsible. There's a story about me that I could tell at another time. I was not responsible. I should not have started when I was in college. But if you are, you could. You can get a credit card. You can limit yourself to just one. There's no need for you to have multiple at that stage. Pay it off each month. Put small amounts on it and pay it off. What you're doing is you're showing them that you're responsible and you're building your credit. If you don't know when you're going to be able to pay off an item, don't purchase it on credit. Don't do it. Just save up your money for it, because otherwise you're going to get yourself into a world of hurt. Listen, I sure appreciate you spending time with us today. Credit is really important when it comes to personal finance. If you can't grasp this, it's going to be really hard to manage in life. And I want all of you to have really strong credit. Thank you so much.